Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 22nd of June. I'm Daniel Lam, your host for the podcast. In our latest second half global market outlook, we continue to be overweight gold, but we did dial back our forecast with 3-month target at 4,750 and 12-month at 5,100. Now, the long-term case for gold remains intact, but the rally's drivers are becoming more balanced. Gold's sensitivity to traditional macro factors, particularly real yields and the US dollar, has re-emerged after weakening earlier in the cycle. Now, both of these are likely to stay elevated, and higher carrying cost should limit the pace of gains in the near term and raise the risk of some profit taking. But nonetheless, ongoing diversification, residual geopolitical risk, and of course, central bank demand should continue to provide underlying support. Now, we've talked about central bank demand in our podcast on the 15th of June, that they are continuing to diversify away from the US dollar. And the latest survey on central banks' gold appetite should alleviate market fears of a swing to net selling. So according to the 2026 Central Bank Gold Reserve Survey by the World Gold Council, appetite stays firmly positive, in line with the last 4 years. So this coincides with data showing that the official sector added 850 tons globally in 2025. That's equivalent to over $95 billion in value terms, exceeding the previous records of around $80 billion in 2024 and $60 billion in 2023. Now, this year's survey is particularly important and insightful, given record prices in January and then the subsequent sharp correction, as holders liquidated gold during the Middle East conflict. So it is all the more significant because most of the central banks responded to this survey after the start of the conflict. So this survey asked 76 central banks if they expect the share of gold, US dollar, euro, or CNY in total global reserves to change in 5 years. So a record of 83% of respondents expect gold shares to rise, up from only 46% in 2022, when official sector buying first breached 1,000 tons. 89% of respondents expect gold reserves to rise in 12 months, up from 61% in 2022. And a record of 45% of respondents expect their own gold reserves to rise. So this survey indicates that sentiment towards gold has strengthened, and gold should be trading at a higher floor than before. So technically, a case of gold likely making higher highs and higher lows for the medium to the long term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.